Hey, it's Tom here and welcome back to the channel. Now, before we get into this, if I sound kind of funny, I've been a bit under the weather the last couple of days. Nothing too major, but just an FYI if you're wondering why that is the case. Now, the topic of this video is Alibaba. Now, about a month or so ago, we got the pretty big news that Charlie Munger at the Daily Journal Corporation had purchased into Alibaba stock. He put about $37 million into Alibaba, and just in the last couple of days we've now had the news that one of my favorite investors, Mohnish Pabrai, has recently put a pretty similar amount of money into Alibaba, about $38 million in this case, so just nudging past his mentor Charlie Munger by about $1 million. And since that Charlie Munger investment about a month or so ago, I've been able to do a bit more digging and a bit more of a deep dive on the Alibaba business. So this is going to be basically an analysis of Alibaba, going through the standard kind of Phil Town style 4M analysis, the meaning, moat, management, and margin of safety. So going right through from what does the business actually do, right through to who manages the company, and eventually an intrinsic value. So I hope you enjoy the video. If you do, please hit like and hit subscribe. But for now, let's get straight into it. Now, in terms of how Alibaba got onto my radar, of course, we've already talked about the Charlie Munger investment and the Mohnish Pabrai investment. The thing I find quite interesting about the Mohnish Pabrai investment is that these 13F filings that basically showed us this information are on a 90-day delay. So for Charlie Munger to make an investment and then Mohnish Pabrai to have made the same investment, all happening in the same quarter means that Pabrai wouldn't have actually seen in a 13F filing that Charlie Munger had made this investment. So it's not like Munger made the investment in Alibaba, Pabrai saw that in a quarterly filing and then cloned the investment. They actually made the investment at basically the same time. So that's a really interesting thing just to note. And interestingly, Charlie Munger and Mohnish Pabrai are not the only two super investors to have bought Alibaba in the first quarter just gone. There's another name who has also gone into Alibaba, and that's a guy by the name of Greg Alexander with Conifer Management. Now, Greg Alexander flies well under the radar in the investing world, and he's potentially someone you've never heard of, but he is actually one of only two people that Warren Buffett has come out and said, you know, he is quite confident these people could beat the market, and he'd be quite confident to invest his own money with these two people. So Greg Alexander was one of those guys, and Seth Klarman was actually the other individual that Warren Buffett was talking about in that case. And in terms of Greg Alexander's portfolio, Alibaba is a position that he already owned prior to this quarter, but he's added to it quite substantially, and it now is his largest position at about a 20% allocation in his 13F filing. Okay, so let's start working through the 4M checklist of meaning, moat, management, and margin of safety for Alibaba. And let's start off with the meaning. In other words, what does Alibaba actually do? And this is by far and away for me the most challenging part of the analysis, is to actually understand what Alibaba are doing, because Alibaba is a massive, very complex business, and they have a huge number of subsidiaries. I'll put up a screenshot here or a video perhaps showing just a handful of some of the subsidiary businesses that Alibaba own, and they have a lot of sort of different business segments, and they basically break it down into a few different areas. Now, the first and the largest segment in terms of revenue, at least for Alibaba, is their core commerce business. So this includes a few brands, things like Tmall, like Taobao, AliExpress, and also Alibaba itself are all sort of their main e-commerce businesses, obviously large Chinese e-commerce companies. They also have a cloud computing business, which goes by the name of Alibaba Cloud. They have a digital media and entertainment business, as they call it, which goes by Alibaba Music, and also Xiaomi Music. Hopefully I'm not mispronouncing that. And they also have what they call innovation initiatives and other revenue, which is a smaller component of the business, but it has things like amap.com, which is, as far as I can gather, a similar product to something like a Google Maps or an Apple Maps. And also they receive a small amount of income from about a 32.5% ownership stake in a business called Ant Financial, which we'll get to in a lot more detail in this video. And Ant Financial is basically Alipay, which is a massive Chinese payment business. Now, in terms of trying to understand all of those business segments for Alibaba, there's quite a useful podcast that I came across, and that is a podcast by the name of Business Breakdowns, and they actually have an episode specifically on Alibaba. So I would certainly recommend checking that out. There's a guest on that podcast who is very, very familiar with the Alibaba business. Alibaba is typically sort of portrayed as like the Chinese Amazon, but in a lot of ways, Alibaba are actually quite similar to Google, and that is sort of explained and argued for on that podcast. So I'd certainly recommend checking that out if you haven't come across it already. And if you look at a couple of the simple business metrics, things like return on equity, for example, they do actually have quite similar performance to a Google. And Amazon has a slightly higher return on equity, but nonetheless, Alibaba are still cranking out some fairly impressive numbers here, which I will put up on the screen. Now, in terms of the moat for Alibaba, again, this is quite a complex topic. Of course, Alibaba has many different business segments and many different subsidiaries, as I've just sort of described in the earlier part of this video. And this is still something, frankly, I'm trying to wrap my head around, because with each of these different businesses, there's going to be different things that help them to outcompete other companies. So with things like AliExpress and Alibaba itself, for example, they're going to have quite different kind of characteristics that help them push ahead of their competitors than things like the Alibaba cloud service, for example. Those are very different types of businesses for the Alibaba group. But again, I can't help but make comparisons to the American equivalents, if you could call them that, the Googles and the Amazons, where they just have such large kind of networks of all these different products that you can buy online. And at least in my experience, I've purchased things off Alibaba in the past, and you can buy goods from, even here in New Zealand, that are just ridiculously cheap compared to many of the alternative options from other countries or other companies. And with many of these business segments, they are just frankly market leaders. You take something like Ant Financial's Alipay. We have Alipay things that I see in, particularly kind of tourist-heavy places, even in New Zealand. And it's very, very rare to see some payment system that's specific to one region in the world here in New Zealand. We've got things like Apple Pay or like Google Pay, for example, that are really worldwide, but we don't see a lot of one country or a couple of country kind of specific services like Alipay, which we do, for whatever reason, seem to have here in New Zealand. So many of these market-leading business segments for Alibaba are clearly very widely used, and they're really doing their best to build up this big network effect as much as they possibly can. Now, in terms of management, of course, Jack Ma is famous for being the founder of Alibaba, but he's really not heavily involved in the day-to-day management of the business anymore. Rather, the current CEO is a guy by the name of Daniel Zhang. Daniel Zhang was previously the CEO of Taobao, another one of Alibaba's subsidiaries, and he has been the CEO of the Alibaba group since about 2015, and as of 2020, he was actually also named the chairman of the Alibaba group. So if you fire up an annual report from Alibaba, you will see some commentary from Daniel Zhang around the group's operating results for that year. Now, the people aren't the only thing that I like to focus on when it comes to assessing the management team at a business. We also have to focus on the actual business metrics themselves, and really the things that are predominantly in the control of the management team are things like their use of debt, how much cash they keep around, and also things like return on capital and return on equity. And all of these aforementioned metrics for Alibaba Group are really impressive. So I'll put up on the screen here some of the long-term growth that Alibaba have experienced, also their history of return on equity and return on invested capital, and you'll see that this is frankly, from a quantitative perspective at least, a great business. As Warren Buffett defines it, a great business is one that produces a high return on capital, and a really good business is something that produces a high return on capital and grows, which Alibaba are certainly expressing those characteristics here. So let's start to have a look now at the valuation. The fourth M, which is margin of safety, is it currently trading at a discount to its intrinsic value? I suspect it probably is, given the fact that we've had at least 3 super investors buy into it. But nonetheless, I wanted to run some numbers for myself and see what the numbers were actually coming out like when I start to make some estimates about the future cash flows of Alibaba and what the potential intrinsic value actually is. I'm going to show 3 different intrinsic value calculation sort of scenarios up on the screen here, and the first one is a simple kind of approach to putting in a discounted cash flow. So kind of the standard way that I do it, set up what was last year's free cash flow as kind of a base level, and then grow that free cash flow out at a certain percentage growth rate annually and try and come up with an intrinsic value for those future cash flows. Now, in terms of the historic growth that Alibaba have experienced, it's just been spectacular. So they've got a 10-year compounded revenue growth of over 50%, free cash flow growth of approaching 50%, and an earnings per share growth of close to 70%, in fact. So just spectacular growth rates. Now, I would never sort of budget on that moving forward. Of course, Alibaba is now a massive business and it's unlikely to be able to grow at those growth rates out into the future, but certainly you can make an argument that it's still pretty likely to grow relatively fast. Now, in terms of putting that into actual numbers, I've gone with about a 20% growth rate from years 1 to 5 and a 15% growth rate from years 6 to 10. So again, you can be more aggressive here. I like to keep it a little bit more conservative, but nonetheless, 20% and 15% are very large growth rates for a very large company, but I think it's a very justifiable starting point at the very least. So where does that land us? Well, I get a present value of future cash flows of about $880 billion. Now, this is all in US dollars. Depending where you look, you'll see some figures for Alibaba in Chinese yen. You'll see some in US dollars. In the annual report, they actually show both. So I've used US dollars figures here. So we get a present value of future cash flows of about $880 billion. They also have quite a bit of net cash, so about $47 billion roughly of net cash. So cash over and above any debts that they have. So if we combine those two together, we get about $927 billion as an intrinsic value. If we put that on a per share basis, we get about $340 per share. Now, the current share price as of recording this video is a little over $210, so that comes out at very close to about a 40% margin of safety. Now, there's one thing I want to add here that is actually going to make quite a significant change to this intrinsic value calculation. So what I've done here is basically take all of obviously the cash flows that flow through Alibaba's financial statements, and I've run a discounted cash flow based on that, combined with my projections moving forward. Now, one of the things that actually doesn't capture is Alibaba's roughly 1/3 holding in Ant Financial, which is the business that was rebranded from Alipay, about 5 years or so ago. Now, Ant Financial back in 2018 actually did a capital raising at a valuation of about $150 billion US dollars. They were then set to do an IPO not all that long ago at over $300 billion US dollars, so monster valuation. And Alibaba own about 1/3 of that. So if they were to achieve that $300 billion US dollar valuation IPO, Alibaba's proportional ownership would be worth roughly $100 billion US dollars. So very significant ownership in a very large business in Ant Financial. Now, that IPO did actually not end up happening, and I personally like to be a bit more conservative. So I'm going to add right in the sort of net cash or sort of excess capital kind of portion of this discounted cash flow, I'm going to add in that 1/3 ownership of Ant Financial, and I'm going to value it at about $200 billion US dollars, just to be a bit more conservative. So only at about 2/3 of that kind of speculated IPO price of a little over $300 billion. Now, that actually does change the intrinsic value and the margin of safety a little bit for Alibaba. So that now pushes up the intrinsic value per share to about 360 odd US dollars, which gives us a margin of safety at the current share price of about 42%. So that, of course, is a pretty sizable margin of safety, and this is not by any means a recommendation to buy or sell or anything like that with Alibaba. This is kind of me just running through some initial numbers. I personally have a bit more work to do on Alibaba, as you can potentially tell through this video. I don't fully understand every little component of Alibaba's business, but I'm working on it. Any kind of spare moment I'm getting at the moment, I'm trying to further understand the businesses that Alibaba owns. Now, there's one more scenario I want to show you, and that's something I've started doing more recently, and it's kind of working backwards from the current share price. So trying to figure out what percentage growth rate are investors actually expecting based on the current share price. So in other words, let's reduce those expected growth rates for Alibaba down until my intrinsic value assessment comes out at about the current price. And again, if I include that Ant Financial stake, where I'm landing at the moment is about 7.5% to 8% per year compounded growth for the next 10 years. So in other words, in my estimate at least, the current price for Alibaba basically expects, the market's expecting about an 8% per year growth rate if we give it some credit for that Ant Financial stake. So if you think that Alibaba can grow at a higher rate than 8%, then you probably think that Alibaba is undervalued. And if you think that Alibaba is not going to grow at 8%, then you probably think that Alibaba is overvalued. So that's kind of how I'm also working backwards in this last scenario, just using some percentage growth rates in relation to the current price. So that's the news from Mohnish Pabrai's recent 13F filing. I will be doing a video on the additional 13F filings that I follow coming up very soon, so keep an eye out for that. In terms of Alibaba, again, this is something I'm still kind of working through myself at the moment, but there's certainly also some other things to consider. Now, I've just jotted down a few bullet points here. There's a few things that I really want to understand just because this is a Chinese business. It's not a typical US company that has US accounting standards and so on. It's a business that is in China, and it's quite a complex business, and there's a few kind of interesting things that go on when you actually try to buy shares on the New York Stock Exchange. Now, the first one, of course, is what in the world happened with this Ant Financial IPO. It's sort of rumored or speculated, or I don't quite know how to describe it, that that IPO was actually stopped by the powers that be in China. So I want to understand that a little bit more. There's also the fact that Alibaba actually has sort of dual share listing. So you can either buy shares of Alibaba directly on the Hong Kong Stock Exchange, or you can buy shares on the New York Stock Exchange in an ADR, or American Depository Receipt, which is what Charlie Munger, Greg Alexander, and Mohnish Pabrai have all chosen to do. But technically, you're actually buying into an entity in the Cayman Islands that then has ownership in Alibaba, which even saying that out loud makes me a little bit nervous. Now, I do take some comfort from these three super investors at the very least. There may be more that I haven't come across yet. I do take some comfort from these three super investors being comfortable investing through an ADR in that way. But again, that's something I want to further understand and kind of get my head around before I potentially take a position in Alibaba, which I haven't done as of filming this video. So that's it from me for this one. I do hope you enjoyed the video. If you did, please hit like and hit subscribe. If you've got anything you think I might have missed in terms of trying to analyze the Alibaba investment, definitely drop that down in the comments below. I would love to hear from you there. And tell me, do you guys own Alibaba? Have you cloned Mohnish Pabrai or Charlie Munger into one of these investments? Would also love to hear any thoughts on that. But that's it from me for this one, and I will see you in the next video. Cheers.